So you're about to buy a home and you're just not sure how much down payment you should put towards that home. Well, in today's video, we're going to see what's the minimum that you have to put down and what are the implications of putting down the minimum. Let's dive in. So depending on the value of the home that you're buying, there's going to be a minimum down payment that you have to put towards a home. However, there is a higher minimum that you have to put if you want to avoid paying a mortgage insurance. And that minimum typically is 20%. It may be greater than 20% if you have poor credit or there's other reasons. You might even choose to buy one even at higher than 20%. But typically speaking, 20% or less than 20%, you'll have to buy mortgage insurance. Above 20%, you could get away without it. Well, what are the implications involved in all of this? Well, mortgage insurance is an insurance. And if you could avoid paying it, you're saving money. How does it work out? Well, it's essentially they want to back themselves. They want to protect themselves. So if you're only going to put a small portion of the value of the home, let's say you buy a home that's less than $500,000 and you choose to only put 5%, which you're allowed to, well, the bank wants to make sure that if ever you default on this, that they're getting their money back. And 5% is not much. Like they don't have much leeway if the value of the property drops or something else, if they have to sell it quick. So it's not that much. Whereas 20%, they're more secure in this transaction if the house is actually worth that value. So you have this 5% minimum, but for you to access this 5% minimum, you have to buy mortgage insurance. There's many different companies that offer mortgage insurance. There's the Canada Housing Mortgage Corporations, the CHMC, which is one of the main ones, but there's other ones available to you now as well. And if I look at the premiums are often based on the loan value. So don't see these percentages as being, this is going to add my interest payments that are, let's say, 3% with a bank to 6%. No, this is based on the loan value and you pay it once and you're done with it. So if I look on the CHMC website, I could see that up to and including loan to value, so 65% would mean that you have a 35% down payment. That's very large. Normally you'd be taking this insurance when you're at like only putting 15% down, 10% down, or 5% down. And I could see that these loan to value kind of insurance premiums are like 2.8, 3.1, 4%. If you take a second here just to figure it out, let's say you're going and you're giving only 5% on a $300,000 home. Well, 4% of that is $12,000 that this insurance is going to cost you. Okay, and if let's say you're giving 10%, well, it's still like over $9,000. And if you're giving 15%, that's just a little bit less than $9,000. So if you could get away with paying for this mortgage insurance, it's very beneficial for you. And there is another video that I showed talking about the home buyer's plan technique to try to get a little bit more money that will allow you to hopefully avoid having to pay for this mortgage insurance. So here on the Canada website, they go through an example, and through this example, you could see that different levels of down payment lead to different levels of mortgages and then different levels of mortgage loan insurance premium. So you could quickly see that depending on how much you put down, obviously it's going to lead to a much lower cost. Lower costs initially because you have to pay for this fee. And if you think about it, this extra $10,000, $11,000, or $9,000 I had in my situation of $300,000 home with close to 3% loan to value ratio, you have the situation that you're paying an extra $9,000 because you didn't put that extra money in. And then that extra $9,000 is going to accrue interest. And if you think about it, let's say you have 15% down. What is 15% down of 300,000? It's 45,000. What is 20% down of 300,000? It's 60,000. So if you could only put $15,000 more, you're saving close to $9,000 worth of insurance. I'll say this again, if you could find a way to get $15,000 more, you're saving close to $9,000 worth of insurance. Pretty much the same value. And that's like a one-shot deal. It's very quick. And then afterwards, if you found that money somewhere and you put it down, while you're able to save interest for a certain time and so on and so forth. There's a lot of other values added to it, but it really brings the case that if you don't have poor credit and you don't have to get mortgage insurance, if you're above 20% or equal to 20%, then you should really, if you're close to the limit, you should really try to find that extra money through any technique available to be able to pay that 20% and avoid the mortgage insurance. So it's a tool that exists. You might not have a choice to use it. You might be buying a property that's way out of your league and you just don't have much money yet, and so on. And I understand. I used it in the past. I didn't have a choice actually with my condo in Montreal because it had a certain sizing and so on and so forth. Regardless of the down payment, that condo had to go through mortgage insurance just because of its shape and so on. However, if you could avoid it and you're really close to the threshold, I'd highly consider you finding ways to getting that extra money. And if it's a home buyer's plan that I covered in a separate video, can make that happen. And in that video, I showed how you could pretty much get an extra $17,500 relatively rapidly. And in this case here, where you had 45 down payment or 60 needed, you'd get that extra 17,000 would give you above more than 60. And all of a sudden, you could avoid paying this mortgage insurance. So something to consider. Take a look, do your calculations. And obviously, if you're going to run the Excel file for the project in this class, make sure that you embed this information if ever you don't have a 20% down payment. Hope you found this video interesting. I'll catch you on the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.